And 3, 2, 1. Welcome to the show.
All right.
We had a few technical difficulties before we started the show. So if I look like I'm about to explode, that's probably why.
Yeah, I don't think people are, well, hopefully most people watching the show didn't have the week that you and I both just had.
Yeah, Jerry's been doing planes, trains, and automobiles to get back.
Unbelievable.
All right,
so
man.
we're just going to kind of dive into
it.
I got a bunch of things to kind of go through, and I'm going to try to keep it as coordinated, as kind of congealed as I can. Things were pretty solid in this insane market as it is, but they were pretty solid until Friday morning's job report came out, and we'll talk about that a little bit. But I'm gonna start off with the unemployment and the Fed funds rate. Okay, we're going to take a look at the first section of the Fed statement when they met at the end of July, and we'll take a look at what they said is going to happen and kind of how Friday's report affects that. Layoffs are definitely coming. If you've probably seen it in the media by now. I got a bunch of examples that I'm going to kind of flip through pretty quick, but layoffs are definitely coming. It's just that they're not in the data yet that the Fed uses to make its decisions. So it's complicated. And then the conflicting data makes this environment for us extremely difficult to try to navigate. And it just goes back to the thing that we always say, like if you're trying to figure out what's going to happen next, and make reallocation decisions based on what you think is going to happen next, your blood pressure's got to be through the roof. I mean, it is pretty much impossible. I mean, the Fed doesn't know what's going to happen next. I don't know how any of us think we're going to figure it out. So our solution to that is respond to what the market actually does. Okay, bonus chart's going to be Ethereum. It's a pretty good example of some technical analysis, and then the regular TSP fund charts. But before we get to all that, I could not pass up this opportunity. I guess this was Saturday. It might have been Friday and Saturday. I'm not sure. But the TSP, I mean, as rough a time as we're all having in the market, and we're having with our app and some other technical difficulties we had today, the TSP site is so unbelievally jacked up. I just can't.
I feel like it was like they built it on like sand or something, and it's just like shifting all the time.
I mean,
and it's easy for me to say I didn't have to build it, right? But I'm like, oh gosh.
I mean,
the fact that page is there. How long was it there like that?
At least a few hours. I mean, we saw a lot of it on Facebook, and it was Saturday morning that I started seeing it, and eventually people were like, okay, I was able to log in or whatever, but no information. Just it's not available. Sorry, on Saturday morning.
Sorry, we're not here right now.
I mean, I've never seen that in Fidelity.
The squirrels took a coffee break.
I guess.
They're like, hey, man, we got to get some coffee.
We got to get off the treadmill for a minute. Yeah. I don't know. I hope they can get it together. Okay. So here's the first part of the Fed's statement after that last meeting it came out on July 27th, right? So recent indicators of spending and production have softened. All right, so that means that they're acknowledging that the economy is starting to shrink. Okay, we had 2 consecutive quarters of negative GDP growth, which we're not calling a recession because unemployment hasn't gone up. So if you watch the news at all, you can't possibly have missed that, what they politicize into this thing that the administration doesn't want to call it a recession, but everybody else wants to call it a recession because it's 2 consecutive quarters of negative GDP growth. Whatever you call it, I don't know why you bother with a label. It is what it is. So they're acknowledging that spending and production have softened. Nonetheless, job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remains elevated, and they're saying that is a reflection of supply and demand imbalances related to the pandemic, commodities price increases and stuff, and broader price pressure. So the committee seeks to achieve maximum employment and inflation at a rate of 2% over the long run. Okay. The committee decided to raise the target rate of the Fed funds rate to 2.25% to 2.5% and anticipates that ongoing increases in the target rate will be appropriate. The committee is strongly committed to returning inflation to its 2% objective. Inflation right now is at a little over 9%, okay? And we are basically at maximum employment, okay? And then on Friday, the job numbers come out, and the unemployment rate actually fell from 3.6 to 3.5%, right? So the Fed is increasing rates, right, to bring inflation down. Inflation is at over 9%. It wants it to be 2%. So, but it acknowledges that the inflation is a reflection of supply and demand imbalances, not a reflection of employment. So they're in an unbelievable trick bag right here. Employment is getting better, not worse, but they need employment to get worse to bring down inflation. So, I mean, there's a lot of things we could talk about it here, but they are in a serious trick bag. Okay, so the bottom line is they want to see unemployment increase, but unemployment is decreasing, right? Employment is increasing. That's the problem for them. It's good for the economy. It's good for us because we're not losing our jobs. It's bad for the Fed because it's trying to force demand destruction. And it says it's seeing it somehow. Anyway, that's where the Fed is. So, this one from Yahoo Finance, businesses, feel like the economy is weakening. And it is what the Fed said, right? The economy is weakening despite strong data, which they're talking about employment data there, okay? Fed rate cut expectations are misguided, says a former board member of the Fed, right? With declining inflation expectations, right? Because everybody's talking about inflation maybe peaked at that 9.1% number last month, and GDP, lower GDP, because we've had 2 consecutive negative quarters of GDP, right? Some investors anticipate the Fed may pivot to become more dovish with its policy tools. So what that means is if inflation has peaked and it starts to come back down, maybe the Fed doesn't have to keep raising rates, right? Maybe it's raised them enough and it can stop raising rates, which that is a big part of this bull rally that we've had since that June low. So that's kind of where we are with the Fed. In terms of layoffs and stuff, Walmart laid off a couple hundred corporate workers. So not the people that work at Walmart, right? These are the corporate guys. It was 200 of them. So the layoffs aren't really happening at the service sector level. They're happening at the higher end, okay? Robinhood cuts 23% of its jobs, right? HBO Max planned layoffs for major streaming shakeup, right? I found this one on LinkedIn, and it's the next couple of pages. I'm not going to go through it all, but announcements of layoffs, hiring freezes, and rescinded job offers have roiled the tech industry and the startup community for the last several months. Okay, now companies across multiple sectors are making staff cuts as executives worry about possible recession and weigh all manner of adverse near-term effects on their businesses. Okay, so the news is very bad in terms of business, and yet somehow unemployment in the data has not caught up to what these headlines are. Right? So the Fed looks backwards and makes decisions based on backward-looking data, and
the data hasn't caught up yet.
It hasn't caught up yet.
Yeah. So I think we as the normal folks, right?
Yep.
Those of us out here just doing our thing, right? We watch the news, and the news tells us what all these people are saying. And I look back across the last few decades, and before there were no other options to what they told us. And so they never would tell us the nuances of, because it was sound bites, right? So I know I'm getting a little, philosophical here, but the bottom line is not right. I just want to kind of point this out, that this isn't like a new thing. Right. I mean, if you go back to the 50s and 60s and 70s and 80s, like if they told us that inflation was happening, unless you were in the financial industry, you didn't know, right? You got your news from a newspaper, right? And maybe the 6 o'clock news or whatever. Yeah. And so there was very few inputs for information. And so now there's so many that we can do our own research, and they can too. And so, but what you're finding out is it's not a lack of like information and analysis. It's that the machines that actually make this data, like literally machines and people that process that information, it takes time. And a lot of yes, computers are doing it, but people are doing it. And so, as Jerry pointed out, the data is not as fast as the analysis. So the data, I'm trying to get my hands in camera, the data's back here. Yeah. We're making analysis on this data, not this one, if that makes sense. I mean, that's kind of what we're saying is we're making decisions about data that's like here, and we're really here. Right. We're really right here. And it's like, oh, so we may have unemployment because everything's happening faster because it's a digital economy. And also, I wonder, this is the part I want to, like, it'd be nice if somebody is out there figuring out, because this word unemployment and employment, to me, we don't have the right definition anymore. Yeah. Because so many people out there are doing their own thing in a digital economy, and you don't know how many. And so if there's enough people not working for Walmart or Bob Evans or whatever, right? Like if there's not enough regular employment of what we think about as I work a 9 to 5, I work for a company, if I'm a consultant or a contractor and I work for 5 different companies, right? I'm really a sole proprietor of my own company. Where does that fit in? Right. And so how does that get counted? And I'm sure there's a way, but I'm pretty sure it has to be a guess, because we don't report to anybody in that. Right.
Well, a lot of these are surveys.
We fall into that, right?
Yeah, we do, but a lot of these are surveys. Like they call you and say, "Do you have a job?
Right,
Did you have a job 9 months ago? Do you expect to have a job in 6 months?" Like that. They're surveys, and so it's the Michigan Household Survey, and they get all this information from that. And
they must never call gov workers, because I've never had that. I've never had that call.
Yeah, I mean, if you're anybody that answers the phone when the number says
first of
unknown
all,
or whatever,
who the hell's answering the phone anymore?
I mean, come on, right.
If you sent that to me in email, I'd be like, yeah. But all this stuff we're kind of kicking back and forth should alarm us on the data that they're giving us, or the analysis that everybody's giving us and telling us. And I guarantee you, again, it's not just us. Yeah. Everybody up the chain, all the way to the Fed committee, they're getting their information the same way, because we all have access to it now.
Yeah. The thing that's good for us little guys, right? And if you watch Wealthion, we've talked about that a few times. It's a great source on YouTube. I saw a podcast last night, an interview with Mr. Wonderful from Shark Tank, and he's super smart. He was questioning the data, like if unemployment, if the unemployment rate is not increasing, but we have 2 consecutive quarters of a shrinking economy, how can that be? One possibility is that the people because if unemployment is going down, it means more people are being employed, right? If those people that are being employed are at a super low level, and yet you got 200 people from corporate Walmart, a bunch of people from big tech in Silicon Valley, a bunch of people from finance in New York. So the people that are making a lot of money now are starting to get laid off. But so kind of to your point, like, a job isn't a job. Like if you say, if I'm employed and I'm making $500,000 a year, and somebody else is employed and they're making $50,000 a year, that counts as 2 people are employed.
Right.
But it's not the same, right? It doesn't have the same effect on the economy. So we can have, apparently, because we have it, a shrinking economy and a robust employment, right?
Yeah. And you see such at least, again, this is just, I look around and all I see is help wanted ads.
Right.
Right. Everywhere. I went in to get a coffee this morning, help wanted, like extremely wanted, right? They need people. Now, again, to your point though, this is on the low level.
At the coffee shop, you see that.
Yeah,
Right.
And what you see at the higher levels of the corporate world or what have you, that they're shrinking because they're like businesses slowing down, revenue slowing down, and the best way to get that is you cut workers, right? You cut your employees, and that's not a good sign. So the system is a little off kilter here, and it's really not being explained very well. I don't think.
What that enables us to do as like TSP guys, right? Is I sort of hate to say this, but it sort of forms our crystal ball, right? If we know that all these layoffs have been announced and they're coming, but they're not reflected yet in the data, we can look at the current rally, this bull market that we're in right now, this little bear market rally, and be very suspect, right? I mean,
instead of getting too happy, which you shouldn't anyway, right? But I can hear some people out, that if you regularly watch this show, they're going, "What are you guys talking about?" So if you always tell us that none of this really impacts it, and it's not that it doesn't impact it; it's that at the end of the day, it doesn't matter. What matters is the price and the volume, right? So, but it is nice to know what may be coming. And so that helps form your bias a little bit because we all have it. And we are emotional, all of us, so you are going to have that. So what it's nice to do is to kind of be like, okay, well, I could see this may be coming. Like, at the end of the day, watch the charts.
Yeah. At the end of the day, for sure, watch the charts. And sort of for my bias, like when we're in a bull market and it's a real bull market, not this, what's going to turn out to be a head fake, I'm sure. If you're in a bull market, I would give the benefit of the doubt to being in the stock funds, even as it comes down a little bit, touches that 20-day moving average line, maybe closes a little bit below it. Maybe I'll give it an extra day because the trend is up, right? In this case, I'm cutting my losses really short, right? I'm not giving it any room to the upside. I'm erring to the downside, right? So that's kind of what I mean. Like, it'll form your bias that way.
We need to get a little bear that you put a Halloween mask of a bull on it.
Yeah, right. That's kind of how it is right now.
Because that's what it is. It's Halloween right now because the bear is wearing a bull mask, and everybody's like, "Oh, it might be a bull." Yeah. No, look below the mask, still a bear.
Yeah. So let me think. In the newsletter this weekend, I compared the 2008 bear market rally because we had a 50%. Rally for a couple of months in 2008, and it was before the big collapse in 2008. It was we had a 20% move down from the high in 2007, had a 50% recovery, rolled over, went back to test the lows, kind of went sideways for a little bit, and then Lehman Brothers collapsed and the market tanked, and ultimately was down 57% at the low. So the similarities between where we are now and 2008 are very significant. So I'm basically in the newsletter, I did this kind of analysis of what a bear market looked like between those two. On the next webinar for this group is going to be what is a bear market rally? Like what does it look like? How do you know you're in it? How is it different from how do you know the difference between the market bottomed and we're in what's going to be a new run higher versus a bear market rally?
Yeah.
So guys want to sign up for that.
Which means, we're still in a bear market, but we had just a little bump up. That's different than it's now a bull market.
Right. It gets complicated. It gets complicated, but it's really pretty simple. If we're in a down move, right, it never goes in a straight line. So it comes down, it comes back up. That little coming back up, that's the bull market rally that we're talking about, the bear rally that we're talking about, right? It rolls over. It doesn't you can't confirm it until it gets below that prior low.
Yeah.
But you can see how it plays out, and it'll tell you the Elliott wave count, the way that the price moves. There are a lot of things that you can see along the way that are technical analysis things, in addition to your kind of fundamental bias of, hey, we know we have all this unemployment or layoffs coming, and the Fed is going to keep raising rates because their thing is employment is great, is very strong right now, which gives them the ability to keep raising rates to fight inflation. So we know all these problems are coming. And yet we're watching we're watching prices move higher. So how are they moving higher? Makes all the difference. But we're going to get into all that on the webinar in September. Okay. So the rest of this is it's stuck is what it is. Give me a second here. Let me see if I can
Of course
make this.
it is.
Okay. All right. Okay. So here we were with the LinkedIn article, and so what they do is they go through and they're like, this year's layoffs have ushered in new trend. Wall Street Journal announces all these job losses, right? So we got pages, right? Walmart, Robinhood, Oracle, Shopify, and it's not just tech. I mean, there's tons of big companies in here that are reducing, right? Food tech startup Lunchbox, 33% of its workforce. Ford, 8,000 jobs. Assurian is a big finance company, 750 employees. It just goes on and on. I mean, there's pages and pages of big companies that are announcing layoffs, and it's from all over, all different sectors. I heard a stat today actually that said Amazon laid off 100,000 workers in the second quarter of this year. Just Amazon, 100,000 layoffs, and yet it doesn't get reflected in the data that the Fed uses. So it's coming. The recession that's not here yet is definitely coming. It's just not officially here yet. And so the mixed messages is what will drive people nuts if you don't really understand what we're talking about. So what Wall Street's saying about the shock July jobs report, right? So on Friday, they come out and say the economy added 528,000 new jobs in July, right? It pushes the unemployment rate down from 3.6 to 3.5%. Ahead of this data, economists expected the report to show just 250,000 jobs added. So there were twice as many jobs added as what people expected, okay? Notably, these gains completed the labor market's recovery from the hit it took during the pandemic. So a different MarketWatch article, remarkably and completely counter to the economic consensus, today's employment report continued to display considerable strength in hiring across U.S. despite what appears to be a slowing economic landscape, right? Says BlackRock. So everybody sees what it is, that the economy is contracting, and yet the employment numbers are strong. And we've never been in this situation before. Says Kevin O'Leary, actually. Okay. Moving forward a little bit, right? September is the next Fed meeting, okay? So it's a long time in terms of the market until late September, right, when the next Fed meeting is. But Friday's red hot jobs report has traders penciling in a third 75 basis point rise in the Fed funds rate at that meeting in September. So the idea is that the Fed doesn't have to pivot because it's not getting a reduction in employment that it wants to. So it's going to be able to keep raising rates, which should ultimately have an effect on stock prices. But we shall see. There's a whole lot to talk about. People can be on both sides of the fence. At the end of the day, if we're above that 20-day moving average line, you want to be in the stock funds. As long as RSI is above 50, we're good. If not, you want to be out of it. That's at the end of the day all we can do. Okay, bonus chart is Ethereum. So a couple things I wanted to point out about this. Same kinds of the stack that I kind of always look at. Once price gets above the 20-day moving average line, RSI gets above 50, CCI gets above 0, MACD turns positive, we have a pretty sustained rally for a little bit. Once we break down through that 20-day moving average line, RSI gets below 50, CCI is back down here. MACD crossed. We get this long move down, and we get resistance there every time price tries to get above that 20-day. It can't do it. So it's not, this methodology isn't 100%, but it's pretty good. We had a breakout in Ethereum, kind of went along with this June low. Pretty strong breakout there on that day, above that 20-day moving average line. RSI gets above 50. CCI goes way up in a hurry, and MACD had already crossed positive. So that's great. We've kind of talked about those signs before. The next thing is what happens when it does a retest of that 20-day moving average line. So it got support there, right? And it got support when it came down close to that 50 line and moves higher. Now it came down, tested it again. And we had on Friday a support again at that 20-day moving average line on pretty big volume right there, right? The other thing to kind of point out here is this idea of capitulation. So a lot of people are saying, well, when you have high volume selling, right? When the volume spike is red, it means a lot of people are selling. And that's what happened. We had a capitulation moment right here, but it doesn't mean it's the end and we only move higher, right? What happens after that capitulation moment is pretty important. We didn't turn back up and move much higher, right? We kind of went sideways to down. And so the value of that capitulation signal it wasn't very useful. It was useful basically because the market said, nah, we capitulated, but there's still a long way down to go. And then we had it again down here, which turned out to be, right at that final low, most recent low anyway. So what I'm saying is just because we get big spikes in selling, it means a low is in, right? This was a low, but it obviously wasn't the final low. Okay. TSP fund charts. Where are we right now? If you are tracking your TSP on a weekly basis, right? We've said this all the time. Once price gets above that 20-week moving average line, because this is a weekly chart, not daily, right? So now the blue line is a 20-week moving average line. Once price got above that 20-week moving average line, it stayed there, got support, right? Price keeps moving higher. We get support all the way along until January. Okay. We got above it a little bit here, but ultimately, every time price tries to get back above that 20-week moving average line, it gets pushed back down and price continues lower. So for the past couple of weeks, we've had this rally. Last week, the S&P closed above that 20-week moving average line. At that point, RSI was still a little bit below 50. And then this week, we had a little bit of a move higher. And so it's trying to find support. It's trying to stay above that 20-week moving average line. Does something like this happen, right? And the market rolls back down and goes to new lows? That's possible. It's also possible that it finds support here and keeps going higher, and the 20-week moving average line starts to turn up, and we start getting support, right? So the longer we stay above 50, the more likely the rally is good. And we're right at the juncture of it right now. S-Fund, same kind of idea. We closed above it this week. We hadn't closed above it last week. We're still just shy of that 50 RSI line. And we've had a pretty big move on the S-Fund, really, from 1,500 to about 1,750 on a percentage basis. It's a pretty good move. It's certainly the biggest rally that we've had since this move back here. So it's been over a year that we've seen this kind of a move in the S-Fund. If it can find support and stay above that 20-week moving average line, it moves higher. iFund is kind of a good example of what also could happen with the CNS funds, right? Every time once it got below it here, in November last year. Got a little bit back above the 20-week line here, and then every other time it hits resistance. And what happened this time? We get a bottom here in June, and then 2 solid weeks of a rally right up to that 20-week moving average line, and then this week reversed right on it. And RSI never did get to 50, and it's rolling back over. So, right now the I fund is something that I wouldn't want to be in. The CNS funds, they're above their 20-week moving average line. So if you get in it now, it's there's no guarantees that it goes higher, but the longer it stays above that 20-week moving average line, the longer, the more likely it continues in that direction. Interesting, I'm stuck again. Okay. F fund. There's so much going on here beyond the technical analysis of it, but we got above the 20-week moving average line on last week. Just barely got above it. This week, huge negative engulfing candle, right? So negative engulfing candle means we engulfed both the high from last week and the low from last week. We engulfed that this week. So it's a very bearish sign. And most of that was from Friday, because once that employment number came out, everybody realized it gave the Fed the ability to raise rates. And when rates go up, the bond funds go down, which is why we have this huge negative engulfing candle. And we hit resistance there right at the 50 line. So it's very likely that the F fund goes down from here. Okay. Wish I had more good news.
Questions.
It's going to be an exciting rest of the month, rest of the summer. I don't know how people do it that really pay attention to this stuff. If they're trying to anticipate and make decisions based on what they think is going to happen, I can't get my mind around it.
I just realized that the bull's butt is in everybody's face that way. I guess it's the
it's
same way. Now just got a hairy arm and
nice.
Either way, his butt's in the.
That's weird. Well, it's all right. We should have a bear mauling the bull anyway.
Now it looks right because that camera picks it up right, but his butt's sticking up in the air, so that's all you see in the other shot.
That's
all right. If you have any questions about where the bull's butt's going to be, send it to us.
We want to hear it.
Yeah. Anywhere you find this video, there's a comment section. You can leave us a question. If you find it without a comment section, just shoot us an email. support@growmytsp.com.
All right, guys.
Hope you guys have a great week. We'll see you soon.
Out.
And music? Do we have music? We got music.